So the Nasdaq continues to sell off. Hopefully, you use this opportunity to get short some of your favorite tech stocks because there's definitely a good opportunity to get out there and get short. It's important, like I said in my last video, to pay attention to levels, to know your supports, to know your resistances so that you trade them accordingly. A lot of people saw the market start to pull back, a huge up day in the Dow, thinking that perhaps maybe tech would rally. I heard people over the weekend talking about the sell-off is maybe over, the correction is done. And I'm like, over? It's a 10%. The market's down 10% in the Nasdaq. What are you talking about? I was like, what kind of correction? I was like, what kind of correction is that? You're looking for 30, 40, 50% correction, not 10%. 10% is nothing. Market could pull back 10% and still keep on going another 30, 40%. And I said Tesla closed below the support, right? And I was talking to a buddy of mine who trades Tesla, and he was like, "Yeah, but it closed close enough." I was like, "But it closed lower than the support, and that always matters." And look what happened. As a result, closing below 600, you can see where my support line is. And Tesla closed below. Your next area that you're gonna see is 480. Tesla is probably more than likely gonna test 480 because the interest rates, right? The interest rates are still going up. Right, like I said in my last video, we still have a long way to go to where our next area of resistance is, right? So our next area is right there at 2%. We still have a ways to go. Unless something changes, the interest rates are still going to rise. Another thing that's important is we're going to look back. We're going to look back a little bit at the bigger picture, right? All the way back to 2013. And that's why I want you to see how strong this area of resistance is. So the 10-year yield has not been above, let's just say 1.4 since 2013, right? Since about 2013 in July was how far back this resistance, this area of support. As you can see, we bounced off of it here. We bounced off of it here. We bounced off of it here, and we broke through it during the outbreak. But looking now more on the day-to-day, as you can see what happened, right? We hit it once, twice, 3 times, right? So we hit the area that was our area of support. It became an area of resistance, right? And then again, we saw it shoot up above. And then what did it immediately do? It retested it. Are you sure that's going to be your support? Market says yes. Are you sure you're going to support there? Buyer step in and say yes. Are you sure you're going to support there? Buyer stays yes, and boom, to the upside. So when you see this, then you know that this area becomes an area of support, and it becomes a strong area of support because one, we tested it on multiple days, both on the buy side and on the sell side. But then looking back at history, we see that in history, going back at least another 8 years, that the market utilized this as an area of support. So we will see the 10-year trade higher, which is going to drag the Nasdaq down. Right, so a lot of your favorite tech stocks are going to pull back. So for me, and what I'm going to be looking for me, if I was looking to buy into companies like Apple, I would probably wait for Apple 100. 85 to 100 is where I had been wanting to get into Apple. I said it on my last video when Apple came down here, that's where I was looking to buy. I wasn't going to start buying so maybe 100, but I felt more comfortable with a support with around 85, 88. We could see that this time around. Good buying opportunity for me. And of course, if it starts to come down, I know Apple is a solid company. It's going to rebound. So it's one of the more safer companies. Apple's already down, what, 15% maybe? Apple down, yeah, 20% already. But for me, I'm looking for Apple to at least come down 30%. And more comfortably, if we come down 40%, then I would think Apple is a bargain. 10% is not really a bargain. I mean, you go to some of these clothing stores or wherever it is, 10%, you're not really going to get people in the door. Where you really get people in the door is when you start showing those signs where you're 50% off, right? Those 40 to 50%, 75%, fucking everything's got to go, right? Then you get people in the door because people realize that what they're buying is at least a value and they're getting it on the cheaps. When you're talking about 10% off, 15% off, I mean, most of these stocks are severely overvalued. And so for me, I'm not gonna put my money there. Just like I said with Tesla. For me, I said Tesla 200, and we're going to see Tesla 400. That's just my opinion. That's the way I'm going to play it. I'm going to look at, if we break 400, then I'm not even going to think about Tesla. So like I said, where I comfortably feel comfortable buying Tesla, which is Tesla 200. And then I'll think about it. And then if it still looks overvalued, I still won't buy it. But it is what it is. The next thing I'm going to talk about, I talked about the SQQQs, right? So I knew that the Nasdaq was going to drag back down. So in my last video, I had talked about it, that I was adding SQQs as my hedge into my risk portion. But I only had a little bit. I didn't have too much cash. I added a little bit more cash. And as you can see, I'm up 100. But more importantly, in my Webull account, I had taken a much bigger position. I was short, or I should say I was long, about 280 shares of SQQs. It came all the way up on Friday to, I believe, 16 or 17. We'll take a look at it, right? So we saw it trade last week, and then we saw a little bit of a pullback, right? Yeah, right here. So we saw they trade all the way up to the high was 1678. I sold a little bit at 16. I had 282. I sold out of 182 shares. I took profits because I saw the market looking strong, and I knew the market was going to retest to the upside over the weekend. So I was like, you know what? I'm going to take profits and I'm going to rebuy. And that's exactly what I did in my Webull. So I bought a little bit more. I put in another $75 into my M1 because I only had about $1,000 to distribute into my portfolio, and so I distributed that into multiple different stocks, some dividend paying stocks, some stocks that were breaking out, and some other stocks that we'll talk about in a little bit. But like I said, in terms of what I was doing in my Webull account, we'll show that right here, right? So SQQs, I bought a little bit more. I only had 100, ended up getting an additional 55 shares. I was hoping I was going to see a little bit more of a pullback. Unfortunately, we didn't, but I was able to get an additional 55 shares. And of course, I had been talking about TNK, and like I called out in my last video, I bought a little bit more. I wanted to get more, but I went to sleep during the daytime, and I woke up after the market closed because I worked over this weekend at the hospital. But I still have Wells Fargo in my portfolio, and you can see it right here, right? I called out Wells Fargo a long time ago. As you can see, we're in 121 shares at 26.51. I called this out way back. I got in before 26.51, but I kept on averaging in. And as you can see, we're doing quite well in the stock. This is a long-term play for me. I had said that just basically looking back at the chart, looking back several years, all the way back into the 90s, that what we saw in the 90s happened again during the financial crash of 2008, and we saw the exact same thing again happen a third time during the most recent crash regarding the pandemic. And so that was basically my thought process. One, Wells Fargo was starting to base out. Two, it is a good company. Despite what's been happening, they've been doing what they can to clean up the books, making themselves look solid for buybacks, and solid, of course, for reintroducing a much bigger dividend, which is why I particularly played it for the capital gains on the way up. But more importantly, as we're going to see Wells Fargo come back with those juicy dividends, it's only paying 10 cents now. But when, like I said, when you look back into its history, when it cuts the dividend, starts out the exact same way. And then eventually they're going to come back and start bringing back those huge dividends. So we're poised for some really big returns in Wells Fargo. Like I said with QQQs, I know the Nasdaq is going to drag. If I see the Nasdaq break below my next area of support, which is 12,200, I know that my SQQs are gonna come back up. More than likely, we're gonna test the moving average. But for me, comfortably speaking, like I said in my last video, that more than likely we could see the Nasdaq come all the way down to 10.8. But like I said in that video, I like 9,800. 9,800 on the Nasdaq is where I'm a bit more interested in buying, and we still have quite a bit to go. In terms of percentage, we're looking at least another 20%, which is what I said in that video. Nasdaq could fall at least another 20% comfortably. And if interest rates continue to rise, Nasdaq is going to continue to fall. I think what they're doing, I think they're trying to squeeze some of these zombie companies out of the market because a lot of them have gorged on a lot of debt. And a lot of these drag down on the overall market because one, they get extra financing that a lot of these companies don't deserve. Two, they end up with a lot of people who work for them who could be working for more successful companies, but since they're able to gorge on debt, they're still able to pay out to these individuals. And that, of course, holds down the market itself overall, because now you have resources, whether it's financial resources or if it's just people that are going to companies that are basically no good. They're just zombie companies. They don't make money. But anyways, we're gonna leave it there. My last one I talked about last time was TNK. TNK, a bit of a slow mover, and I'm paying attention to this one for a breakout above 14. As you can see, we were at 14, but we did sell off. We did retest 13, came down intraday, bounced off of the moving average on several days. As you can see, intraday, the stock did fall below, but we rallied back, and it was on those days where the market fell a little bit down. But as you can see, we're still holding within this 13 to 14 channel. On a breakout, I'm looking to add more. I've got 220 shares from 13.16, and I'm waiting to see a little bit more to the upside, because I know information wise, the tankers, especially these marine shipping tankers, there's a shortage, which means, and prices are rising, which more than likely what people will think, buy the stock. As you can see, we're also trading below the 200, which gives me an extra area of support. This is basically how I'm playing this stock. One of the other ones talking about Golden Nugget. Not the biggest fan of this stock, but it's showing stability. As you can see, where our next area of support is $12, and so that's why I bought it down here. I'm currently long a little bit higher than I should be. I did average a little bit down. I'm long here at 14.10. Right, so I started buying it over here. It fell a little bit more, and unfortunately I didn't scoop up enough, but I did buy a little bit more. I did buy a little bit more today on a little bit of a pullback. If we come back down here into those 12s, I'll scoop up, because I want at least another. We're going to go for 250 shares. We could see a rebound in Golden Nugget, which wouldn't be too bad. As you can see, this is a much sturdy area of support, because you can see how much time we spent there with multiple days where we were testing $12. So I feel a bit more comfortable holding this position, especially as more sporting events are going to be starting to get open for the summertime. You might see more sporting bets for basketball, football, etc. Moving forward, soccer. So Golden Nugget might benefit from it, but at the very least, looking at it technically from a technical analysis standpoint, the stock is showing some stability here at around $12. And so I'm going to hold and hopefully average down a little bit more. If the stock comes below 13, I want to buy a little bit more. If it breaks through on any sort of a volume, I'm going to get out, because I know that my next area is going to be down here at 12. So I'm not looking to hold 50 shares, an additional 2 or 3 points. I'm not looking to lose money like that. Well, what else did we put in? We added a little bit of money to some of our dividend plays. Let's just take a look here. We saw also Exxon Mobil on the breakout on the day. As you can see, currently the overall portfolio again up above 16,000, and a little bit in dividends come through. $20 in dividends, up 860 on the day, up 1,800 on the week, and for the month we're up 3,000. Right. So this was a long-term portfolio designed for dividends. And so I added a little bit more in terms for my risk to companies like Baba. Baba actually broke support, but I do like it on the long term. But we're bouncing right back here to our original position right here. So I bought a little bit more, put it in, I think I put in another 150 into this play. I think I've got a little bit more time to accumulate, but I don't want to dump all of my money in all at once, just in this one play, just in case it doesn't break. CRM is another stock, of course, I'll be looking at. It did break through that 2010s, but for me, I feel comfortable more buying Salesforce down here at 170. I like it much better down here. If you took advantage of the short-term play, where we were up, actually I got in right here around 222. So this play we were up about 12%, but I was looking for this stock to come back up and keep moving, but of course weren't paying attention to the rotation in the Nasdaq. CRM, like I said, I feel much more comfortable buying Salesforce down here at the 170s. As you can see, solid area of resistance. Where multiple days for a long period of time the stock could not rally. and then finally the stock rallied through it. Stock rallied through 170s. See a little bit of a consolidation and then a breakout. And that's what I'm perceiving that will happen in the future. So we've got a little bit more to go. Again, we saw the stock break above and close close to the resistance with a gap up. But what happened? Stock sold off, indicating that 210 is not strong enough to hold the stock. There are not enough buyers. Seeing the sector rotation, people are not looking to buy. My last stock that I think I'm going to talk about, which I am building a position right now as interest rates start to rise, you're going to see companies that are more designed around housing start to sell off. At least this one particular company that I'm paying attention to, which is Redfin. So I added a little bit. For me, I like Redfin 56. I'm probably going to end up having more cash available in my Webull account than in my M1 account, but I did take a very small position in Redfin that you can see right here. Only put in, oh damn, I only put in that little bit. Hopefully I'll have a little bit more money tomorrow. I have to wait and see, because I do plan on selling my last little bit of JetBlue probably tomorrow. Another one that I spoke about back then, but let's finish with Redfin. Redfin, in my opinion, has strong areas of support at around $55, $56, coming up on the moving average as well. It's had a nice pullback from its highs of roughly 40%. It's a solid company with solid earnings. That's typically what you should be looking for. Find companies that actually make money, not a lot of these EV stocks and stocks like Fuel Cell and NNDM and all these other stocks that don't make money. They're just pump and dump stocks. And as soon as the market starts to slide, they slide heavily. Redfin for me is a good buy at around that $55 at the very least. I started taking a small position. More than likely, I'm going to take about a 25 to 50 share position in Redfin, just because I've only got about 10,000 in buying power. So I don't want it to eat up all of my buying power, because this is probably a play where I'm going to have to hold it for quite some time. So hopefully I'll be able to sell the last little bit of my JetBlue. I did sell out of I only had about another $589 in JetBlue, because I had been selling as the stock had been breaking out. Looking at JetBlue, as you can see, very strong at the end of the day, breaking out of that 19 would look like 1950, right? And of course we broke out on volume. Average volume is 10. Volume in JetBlue for the day on the breakout, showing that it was very strong, almost 16 million. So I've only got a little bit left, as you can see. Let's go back here. I sold out the last little bit today, and I've only got another 269 shares, $269 left. As you can see, where is it? JetBlue. We've made about 800 in JetBlue, which is fine. I really didn't have that big of a position in it, but I dipped back into it on the buyback. What I did add into was companies like NEO. NEO I added a little bit more. I believe I added another 100 in CRM, another 100 into Bava, and Redfin. Those are basically my plays. And I sold about $250 worth of JetBlue. I was waiting to see where it was going to close. More than likely the stock will gap up. Had a huge day, almost up 10%. I'm going to take the last little bit of my profits, because that's where I was looking to sell, even though I do think it's going to trade a little bit higher. But I want to start getting ready in some of my other positions where I really want to add to, where I do see the stock's going to move 30, 40, and 50%. I think JetBlue probably going to move and probably test into the upper 20s. We could see an additional 11%. Have to wait and see. But for me, I'm looking to rotate the money that I made here and maybe rotate it into dividends or rotate it into other short-term growth opportunities, where I can then take those profits, throw that into dividend plays, and then take the principal that I had and reinvest it back into my risk portion of my portfolio, which is basically what this whole position is. This 16,000 that I have here is basically the risk portion, and I take all these profits and I dump them into dividend playing stocks. The last thing I did want to talk about was I had sold out a little bit of my JP Morgan because it was very high. It looked like it had been topping. And so I decided, I only had a little bit. I had about $900 in. I sold it all just because it seemed very overstretched. I'm not quite sure how far it's going to move to the upside. But it also paid a small little dividend. And unfortunately, I had gotten in really late. So I was like, you know what? Let's take this $800 and let's take the profits that we got from it, because we bought it way down here, right? We got it down here and we sold it all the way up here. And so what I decided to do was to put my money into JEPI. JEPI is JP Morgan's ETF, and it pays, as you can see, a huge dividend of 8.25, right? So this company, I should say this ETF, has previously existed, but it only existed for like the millionaires, for people who are very wealthy, because the minimum buy-in was $1 million. Minimum buy-in was $1 million. And as you can see, their goal is to pay 8 point something percent, and it's a monthly paying dividend stock. Hey, I like it. JP Morgan does solid work. So I decided to take a small position into it. If it pulls back, that's fine. The yield will just go higher. And then I'll basically wait. But as you can see, it does pay a solid little dividend. I'm not sure if it paid like a special dividend here at some point. But looking at the stock, he's a solid 8%. And so 8% is good for me. JP Morgan, I like the company. I think they're going to do quite well. So in terms of my dividend, I added it into my financial portion, and I took a little bit right here, 300. I bought 300, and I'm probably going to scale in maybe another 1,500 into this particular, just because it's a little bit more on the risk side, because it pays a high yield. Typically, very high yielding positions typically are a little bit more risky. Now, of course, stocks like Gain, I bought way back, and I had messed with Gain way back from 2017, 18, 19. I held this for years, and I knew it was a good company, which is why I felt comfortable putting a good portion into it. But I got in on the lows. JEPI is new, at least for me. And as you can see from the chart, there's not a lot of information in terms of buying and selling. So it's an opportunity to get in, average in, let the stock find a base, and then start adding a little bit more. So I don't want to add too much into my finance, because when I actually look at my pie and I see how diversified I am, I'm very heavily weighted into finance, which is why I sold JP Morgan, and I'm only going to probably add a little bit more. I'll probably be comfortably adding like an additional 1,500, especially if we get a pullback. I want to buy that pullback down into the low 50s and see where it goes from there. I think that was basically it in terms of what I did for the day. As you can see, looking at the overall portfolio, Exxon Mobil doing amazing, IRM amazing, T accumulated most primarily for that 7%, 7 and change dividend. Enbridge, Canadian Oil, I like, and of course a little bit more into dividend paying paying monthly stocks. For example, like LCT. MO has been doing really well. MO also, Altria Group on the breakout. I called this one way back. And of course, excuse me, I bought this thing a little bit further down here. I was hoping to get it down here, but I was late to the party. And of course, now we're seeing a huge breakout above, what is this, 45 area of resistance. Will now more than likely be our area of support. And Altria Group could make its way back up, and it pays a real solid dividend. So we're seeing some really solid rotations back into different companies. Similarly with GlaxoSmithKline, we saw a little bit of a area of resistance down here. Gonna wait and see if we actually break above this $34. We closed really close to it, but we were above it. We were at 35.20. Excuse me. We were at 35.27. We closed just about at that $35 resistance. So if we actually see GSK pays a solid little dividend. IBM was another one that I called out way back. IBM, waiting for IBM to break out. 125 is that IBM breakout. We'll see IBM trade back into the 30s. But that's going to be, this video is getting really long. But as you can see, taking a look at my portfolio, like I said, I was going to be adding into these food stocks, Coca-Cola, Tyson on the breakout, Kellogg's, General Mills. I showed Tyson again. Like I said, Tyson on the breakout from 70s. We're already trading close to 74s. We were at 74s, and the stock has quite a bit to go. Tyson's going to be raising food prices, which means, of course, that food prices are going to go up, which means that Tyson is going to make more money. Tyson expected to raise food prices as high as 30%. And so that's why I said in my last couple of videos to pay attention to food, because I keep reading food shortages. I keep reading food shortages, so I rotate. I pay attention. I talked about Tattoo Chef. It's not quite where I would want it. Neither is the information on Tattoo Chef, right? There isn't a lot of buzz going around about these sort of sectors. For me, I feel much more comfortable buying this 13 to 15 than I do where it is right now. We could see movement to the upside, but I like it much lower. It seems overvalued to me currently. It shouldn't be at the price that it is right now. And we're going to be trading below the moving average, right? As you can see, we could be trading below the moving average, which means the stock is going to head downward, which is a great buying opportunity if you're looking to scoop it up down here between 13 and 15. I'm going to leave it here. This is basically what I'm doing for the next couple of weeks. We'll have to wait and see how the market acts. Thanks for watching. Feel free to like, comment, and subscribe, and I'll check you out next time.